Welcome back, everyone. I am so incredibly excited to have you here for today's explainer. Now, look, we're going to do something a little uncomfortable today, but I promise you it's absolutely necessary. We are dismantling those comfortable financial illusions we all kind of just carry around, and we're looking purely at the cold, hard math. We're going to zoom all the way out from the massive global economic tailwinds, right down to the specific, actionable numbers you literally need to hit by the time you're 45. Okay, let's dive right into our roadmap for this explainer. We're going to start with the illusion of wealth, zoom out to the global currency shift, and then pit stocks versus real estate. After that, we'll hit your personal milestones by age 45 and wrap the whole thing up with an uncomfortable question. All right, section 1, the illusion of wealth. So picture two people, right? Exact same age, making the exact same salary. One of them is going to retire incredibly wealthy, and the other is going to be forced to work until they physically just can't anymore. Why? Well, it comes down to our very first major reality check. Are you confusing ownership with net worth? Think about a 35-year-old who has $200,000 in assets, but also has a $200,000 mortgage. Their net worth is absolute zero, literally zero. But they feel wealthy, because they own things. We have to remember that ownership is not net worth. If your debts outweigh your assets, you aren't just slightly behind the curve. Mathematically speaking, you are completely off the road. Moving on to section 2, the global currency shift. Now, to understand why accumulating real net worth is actually harder today, we've got to look at the changing reality of fiat currency. For the last 80 years, the US dollar has completely dominated global trade. It was the undisputed king, but the geopolitical reality is shifting. Nations in the BRICS coalition, we're talking Brazil, Russia, India, China, and South Africa, they're beginning to bypass the dollar. They are increasingly settling their massive global trades in local currencies, or they're even looking toward gold. This is a monumental shift in how the globe does business. So why the sudden shift? Well, one massive factor is the explosive rise of U.S. debt. In recent years, trillions of dollars have been printed, which mathematically erodes the real purchasing power of paper money. When the global reliance on the dollar shifts at the exact same time the money supply expands, it creates this direct threat of inflation that just quietly eats away at the value of your everyday savings. Your money simply doesn't buy what it used to, for sure. Which brings us to section 3, stocks versus real estate. So what does this all mean? How do we actually protect our wealth? Let's look at the classic debate, housing versus index funds over a 20-year period. Now, what's really interesting here is the breakdown of the true costs. Let's say you buy a $300,000 house with a $60,000 down payment in the year 2004. Your mortgage is right around $1,400, but add in property taxes, insurance, and the 1% maintenance rule, roofs, HVAC systems, plumbing, the whole shebang, your true monthly cost isn't $1,400. It's actually $2,090. By 2024, you sell the house for $600,000. After paying off the remaining mortgage and realtor fees, you end up walking away with about $397,000 in your pocket. But what if you rented instead? Back in 2004, renting a similar home cost about $1,200, and it averaged around $1,550 over those 2 decades. That is a $540 monthly difference compared to the homeowner's true costs. If a highly disciplined renter took that initial $60,000, plus that $540 difference every single month, and invested it into an S&P 500 index fund at historical averages, their portfolio would be worth roughly $860,000. Mathematically, the disciplined renter completely blows the homeowner's net equity return out of the water. But wait a second. If that's the math, why are there so many wealthy homeowners and so few wealthy renters? Well, it basically comes down to human behavior. The mortgage won her for most people because it acted as a forced savings account. It's a psychologically non-optional payment, right? I mean, the bank literally takes your house if you don't pay. The undisciplined stock investor, on the other hand, often panics. They sell during crashes like 2008, or they dip into the fund to buy a new car. So the winner wasn't necessarily the asset class itself. It was the behavior that leverage and mortgages forced upon the individual. Let's bring this down to the personal level. Section 4, milestones by age 45. Let's pivot and see how this builds on your personal timeline. Age 45 is exactly where compound math either saves you or it severely sinks you. Here is the brutal baseline. By 45, your total net worth must be at least 3 times your gross annual income. 3 times. And specifically, your retirement accounts alone should hold approximately 3 times your salary. If you want to retire at 65 using the standard 4% withdrawal rule, the compounding math requires this baseline by age 45. If you're starting from absolute zero at this age, the gap becomes functionally unclosable unless you make some really drastic lifestyle changes. And listen, to build that wealth, you absolutely cannot carry a leak in your boat. Credit cards right now carry an average interest rate of 21%. Meanwhile, the S&P 500 returns a historical average of about 10%. Just do the math on that. Trying to build wealth while carrying high-interest debt means you are mathematically sinking your own boat. You're basically paying a guaranteed 21% return to a massive bank while hoping to squeeze 10% from the market. No way that works out in your favor. So how do we actually build the defense? Step 1. Get a real emergency fund. Not a tiny buffer, but 6 full months of liquid cash available within 24 hours to prevent a sudden emergency from turning into a massive debt event. Step 2. A housing strategy, where your costs simply do not exceed your means, and that's true whether you buy or rent. And step 3, maximize an HSA, a health savings account. It's the only triple tax advantaged account we have in the American system, and it is an absolute shield against sudden medical emergencies. Next up, bulletproofing the future with absolute non-negotiables. First, you have to have disability insurance. You are statistically way more likely to be disabled than to pass away before retirement. Second, you need a clear 529 education plan for your dependents. But here's the absolutely crucial point. You must never sacrifice your own retirement to fund it. You literally cannot borrow money to retire. And finally, build at least one secondary income stream. It's not even just about the extra cash. It's about having optionality and removing a single point of failure from your entire life. Finally, Section 5, the uncomfortable question. This kind of brings us to the ultimate conclusion. Most folks don't actually have a master plan. They just have an accumulation of 20 years of random reactions. A 401k over here, a mortgage there, a credit card balance over there. I challenge you to look at your finances as a cohesive system. Let's slow down for just a second and really think about the 20-year real estate and stock market data we unpacked earlier. We've spent a century in a world where assets basically always went up. But we have to acknowledge that was tied to incredibly unique economic tailwinds, booming population growth, rapidly expanding credit, and dirt-cheap energy. We might have just been living in a long, remarkable run of luck and confidently calling it our financial strategy. You know, you can completely ignore the math. You can avoid calculating your true net worth. But not knowing doesn't change reality. It simply hands the control of your future over to unpredictable external forces. Time, the market, or a medical event will step in and make those decisions for you if you refuse to make them yourself. So I want to leave you with this final, lingering thought. What if the disciplined investor and the responsible homeowner do everything exactly right, but those macro tailwinds just fade away? What if the next 20 years look absolutely nothing like the last? It is time to reassess your financial milestones, build your resilience, and dive deeply into your own numbers. Thank you so much for joining me on this explainer, and I highly encourage you to go run your own math today.